Good day, investors. Today I wanted to take a look at Norway's oil giant Equinor. It's state-owned mostly. It has a balanced portfolio in theory. We'll see how that turns out of oil and gas and then new energy resources. It's the lowest cost producer with strong expertise. And CEO tries to drive in a narrative a balanced growth between new and old, with strong dividends and a nice shareholder reduction history, especially in the last couple of years. I estimate an intrinsic value around 31 with a 9% dividend as of now, which is reflecting the past 12 months. So it's not future proof. Debt is manageable, but of course the company is exposed to global oil and gas prices, especially with a renewable added risk of if those projects actually turn profitable or not. On the meaning side, 67% government owned, so you will have political interference, but it is Norway, so it's not a third world corrupt oil state. They are core in oil and gas, expanding offshore with some new energy resources, more on those later. To reflect this energy transition shift, they actually renamed themselves in 2018 to from Statoil to Equinor. On this summary from their 2024 annual report, I want you to remember only a couple numbers: their oil production, their reserve replacement ratio, meaning they are here for the future, they are not running out of reserves, and they are not, if you are sustaining replacements and growth every year, then you don't run into a situation where arguably BP is today, that you don't have reserves and now you have to spend a lot to replace your reserves. Of course, they had a Russia situation and lots of their reserves were lost, but that would be a high cash outflow for a company. They are not facing that. They are sustainable long term. Return on average capital employed. I have my own number, but it's nice they show their own here. And let's look at the other slide. These are their business areas. On the next slide, we will see the numbers. Exploration, production, Norway. International. You have midstream and marketing and processing. And basically these three areas make money. Renewables lose money. And these other two areas support the other areas. Here you can see the breakdown. So if you compare 24 to 23, you see you have a relatively big drop, 20% plus in their adjusted operating income. That's purely due to oil prices going down, and of course your expenses, everything being equal, rise with inflation, unless you make efficiencies, and then that changes. You can see gas prices actually affecting them maybe more than oil. So this is oil, Brent oil 2% down on the average realized yearly, but you have international gas prices 20%, realized price is 20%, and refining margins, so that's midstream. You can see midstream 3.2 to 2.6, so that dropped more than this part. So this part dropped 20%, this dropped even more. So this is signaling a slowing economy if you have lower refining spreads. You can see that exploration and production, Norway, international, and the US are making up majority of the money, 85 to 90%, with midstream as a nice balancer. And renewables are just losing you money, 400 million and 500 million a year. On the Moat side, one really thing to remember, one of the lowest cost producers. So if you look at this chart on the right, you see Equinor here. What this means is when every other company has to cut costs and production, Equinor doesn't cut anything. Equinor is always making money, actually, and the problem, not a problem, they have a 78% tax, which is in Norway and oil and gas companies, although the effective rate is lower. But what that it means, if oil is $40, everybody else on this list above 40, at least the parts of their production which is above 40, right? Because even, let's say, Shell has production that's below 40. So above 40 production costs, they have to shut it down because it's losing you money. They cut capex, they fire staff. And Equinor still makes if it's let's say it's 22, Equinor makes $18. 78% of that $18 will be taxed away. So, but they still make money. So what this means is they are a less volatile business on the earnings side. Why? Let's say, okay, I'm trying to make this explanation as simple as possible. So let's say you have, let's use Suncor on this example. No, too complicated. Make it simpler. So let's say you have a cost of $100 per barrel. If the oil price is 101, you make $1. At the same rate, if the oil price goes to 102, you, instead of $1, you make $2. That's 100% increase in your profits, only with the marginal $1 increase in oil price. That would happen to a company like Suncor. So they have these huge jumps of their profitability because they are high cost producers. But Equinor, if your cost is 20 and the oil price is 100, you make 80. Don't talk about taxes now. But if the price goes from 100 to 102, you make 82. So that's what, like 5%, less than 5 bit up, more than 5% change. So the same $1 increase or $2 increase does for Suncor, it increases profits by 100%. For Equinor, it increases only by 4, 5, 6%. So they are less volatile as a business because of that. Also, they are placed in Europe, so they can replace Russian oil and gas to an extent, which they did. Most of their production, as we saw, comes from Norway, which is geopolitically safer, that you have your own resources at home, backed by the Norwegian government, although we discussed this is a double-edged sword because of all the renewable agenda possibly there. They have expertise in the North Sea, harsh environment. And I think that one small upside for the renewables part could be if the EU grid really connects, and then you can sell electricity everywhere, and then they produce a lot of electricity, they can sell it to other parts of Europe. In theory, that could work. We'll see if that ever manifests in the numbers. Yeah, this is production again. We saw it on the operating income breakdown. Basically the same story. Although now we jump into production specifically. So you can see Norway is like 65% of production is coming from at home, and then you have the US as the second largest, which is great because they are NATO and long-term allies. Then you have Angola, Brazil. So they are fine from a geopolitical situation perspective. If you look at management, they aim to pay quarterly dividends. The goal is to increase in line with long-term earnings. The board factors in cash flow, capex, and financial flexibility. So I haven't found the clear-cut we pay 50% of net income as dividends policy, but I found this. This is great, gives them flexibility. The CEO focuses on balanced growth with profitable oil, expanding in renewables. Maybe renewables need scale, or maybe he just have to say it because you cannot just abandon renewables. Even with today's narrative shift, even BP said they are going back to oil. Of course, they have to make money to not go bankrupt. And then here, let's focus only the first three. This is earnings, production, Norway, international, and then this is midstream. So what are the KPIs management is paid for? Production, great. Business. UPC, which is unit production cost, great. And break-even project portfolio, great. All these KPIs are amazing for the business. And then you have the midstream, marketing and processing, efficiency, excess, storage volume additions. This is really important because when we have a situation where you have a surplus of oil due to weak demand or just too much production, it becomes more expensive to store oil, right? Because it's less profitable to sell now than sell later. So it becomes more expensive to store them. This is a natural hedge within the company. Otherwise, you pay others like Vopak, which is a Dutch energy storage company, to store it for you. which can be expensive, and if all the demand comes in at once, prices can soar and then adjust the earnings. So this is all good for this. Of course, this is supporting this, so number of wells makes sense, break-even projects make sense. Yeah, this is how you develop, and IT OPEC. So I like it. Nothing is tied to your stock price, which is amazing. Everything is business focused. And then the CEO made $2 million. That's really modest compared to other international oil companies, like especially in the US where they make 15, 20, 30 million a year. Okay, shareholder remuneration history. We have a lot here on this chart. First of all, I would like to say that this is Equinor's share price and this is Brent crude. They trade together. You also see that the green, which is free cash flow, if oil prices go up, the green goes up. Of course, you make more money. What I don't like is when everything goes up, you also buy back more shares. That doesn't make sense. When your stock price is already high, you shouldn't buy back shares. Luckily, actually Equinor bought back shares in 23 and 24 when its share price was dropping with Brent. So at least they didn't buy the peak, they were buying the dips. And then you can see, I made some crisscross here, but you can still see the debt to equity ratio. When oil prices crashed in 2020, you had a rise in debt, and with rising oil prices, debt slowly dropped down, and at a manageable 60% rate. We will see some numbers on those. And then with these buybacks over this 7-year period, the outstanding shares dropped 15%. So that boosts your even if you didn't buy new shares in the company since 2018, your share increased in the company because there were less shareholders, if you didn't sell, of course. From a margin of safety valuation perspective, I would put them at around $31 per share. For this, I used a 10% discount rate. I used the capex of 13 billion. They estimated for 25. I used it, just projected out for all those years. I calculated myself their break even around 27 pre-tax. Of course, on those other chart in 2022, we saw them around 23, 4, 5. So it's kind of there. Their projected oil production I used at 22.15 per day. And then the free cash flow also factored in their effective tax rate over the last 7 years. So after everything, I just take out 40% for taxes. And then you will end up with capex guidance, break-even price, oil prices, really important, oil prices, and production and taxes. You end up with a 2-day intrinsic value at 31 per share. That's kind of in line with their 10 cap from 2024. and much below the 7-year average, because in that 7 years you had a couple really good years with starting with 21, but really 2022 when oil skyrocketed. So this is just averaging out 7 years earnings, multiplying that by 10, and that's your market cap basically. This is doing it with only last year's earnings, multiply that by 10, and then you divide by the shares. So I'm sitting with my 31. I like my projection better, but these historical numbers give you some context. The company is very profitable, but they are highly taxed. Of course, because they are low producer, they would be really profitable. But taxes are really high, 78%, but the effective rate is much lower. As you can see, it's 51% for 24, and on average it was 39. Of course, this year contained some really low tax years, like 2020. And return on equity, 19, 26. This is nice. Return on investment, less nice. And debt to equity, they are below their 7-year average. This is manageable. Of course, their cost of debt is manageable. It's really nice. Let's hope that it doesn't rise. As of now, outlook is that we're gonna have lower interest rates going forward, so this should be coming even down more. And of course, they don't have an issue ever with paying their debt, because when you pay taxes, you pay it after you already paid your interest rate, interest payments. What that means, if their cost is 27, oil prices are high, or not even high, even 50, 60, doesn't matter. Oil prices will never be as low for them to have an issue with paying their interest. First, you get your money, pay your expenses, including interest, and then you pay taxes. So it's only the government who can lose taxes on this. They can never go bankrupt, basically. They are really low risk of doing that. Of course, rates are higher today because in the last couple of years, rates went up from basically zero worldwide. And then you have the coverage ratio, very healthy, and the current ratio, very healthy. Dividend yield, 9%. This is trailing 12 months, so the past year. Going forward, it's going to depend obviously on their cash flows, which are really tied to oil and gas prices. Risk, oil and gas prices, uncertainty around renewables. Although this is such a small segment, even if it just becomes zero value, at least doesn't lose money, whatever. And government involvement, which could cause this whatever to be a bigger issue, right? But so far they seem reasonable, not to really destroy the company for their ideas. Looking at the stock summary table, I have Equinor here. Technically, it should have a 34% upside based on the projection, and it's a modestly profitable company, which would be really profitable if the taxes went down in Norway. So maybe that's a hidden upside. It's a really defensive oil play. So it can be a really interesting company to ride. If you enjoyed, please like and subscribe, and don't forget to give me ideas in the comments below. Thank you, take care, and have a nice day. Bye.